This is TreppWire Week in Review for week ending December 2nd, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, Congress mobilized to avert a rail strike and a fresh round of economic data and Fed comments for investors to react to. Manufacturing contracted last month for the first time since 2020. Consumer inflation slowed more than expected while spending picked up, and more housing data show a softening market. And in jobs, private payrolls grew at the slowest pace since 2021. Manus, markets initially rallied on hopes that there would be a Fed pivot, but they ended lower in anticipation for tomorrow's jobs report. A little back and forth.
We should set the tone here a little bit. We've never done this before. We are recording late in the evening on Thursday night. Normally we do it at about 4 o'clock Eastern time. Tonight we're doing it at 9 p.m. So we've never recorded when NFL football is on. So there's that distraction going on. And we've never done it quite so late in the day. So this could get a little punchy quickly. Hopefully not, but we'll see how it goes. To your point, Martha, the headline this week, I think, was that Fed Chair Powell finally got in line with investor expectations and the Fed minutes. You might recall that several times over the last 6 months, every time the market has rallied, he's kind of pulled the rug from under investors by saying that interest rate hikes would have to be more severe than the market was anticipating. Higher interest rates were going to be necessary, and the length of time where rates were held high would have to be extensive. This month, he was a little bit more dovish. He reiterated that the period of time that rates will remain high will be extensive, but he did say that the pace of rate hikes can start to slow. That's consistent with the Fed minutes, consistent with investor expectations. Once those remarks came out on Wednesday, stocks took off and bond yields fell sharply. Thursday was a little bit more of a mixed bag. You would have thought that we would have picked up where we left off on Wednesday, and we did in the fixed income markets, but we didn't in the equity markets. The big headline Thursday, core PCE, slightly cooler than expected. The bond markets reacted very favorably. Treasury yields fell sharply across the board. The 10-year was down 15 basis points, if I remember correctly. The 2-year was down 13 basis points. The stock investors weren't quite as impressed. Today was a mixed bag. But I think if you're taking one headline away from the week, it's that everybody seems to be looking at future rate hikes the same way. Slow the rate of increases almost immediately, see how we do, and that in turn has led to a rally in the fixed income markets.
Yeah, so just to add a little context to some of the verbiage that you mentioned, Manus, Jerome Powell was quoted as saying it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring down inflation. Fed Governor Michelle Bowman said as we approach a sufficiently restrictive level of the federal funds rate, it will become appropriate for us to slow the pace of rate increases. And then New York Fed President John Williams said that he didn't push back against expectations that the central bank will lift by 0.5 percentage point at the December 13 or 14 meeting. So again, I think they were in lockstep in terms of the messaging this time, even though it was a little bit different than what they've been saying leading up to this point. A couple of other noteworthy things this week. The Senate voted to avert, the rail strike that we talked about a couple of weeks ago. For one of the labor unions, they were able to reach an agreement. For this one, they had not. And so the House approved a similar measure. The Senate voted to impose the tentative agreement from September, before the December 9th date, which the railroad workers were set to strike. So some interesting background on that. I actually come from a railroad family. I wasn't tough enough to make the railroad cut. I had to go into a cushy office job, but my dad, my brother, and my sister all work for the railroad, 2 of them at Union Pacific and 1 at Burlington Northern. And my brother actually runs the service division in Chicago, so the Chicago service unit. So if you order anything for Christmas gifts, his division probably ships it. It's the busiest rail line in the US, and they have a blackout period from Thanksgiving through the first week of the new year. And their mantra is, "We will deliver your Christmas." So it's all hands on deck 24/7. It's pretty remarkable. So I'm glad to see that the people will still be working. Hopefully they come to an actual agreement where everyone feels like they're getting the fair end of that deal. And then if we look at some of the housing numbers, pending home sales fell 4.6% for the fifth straight month. Pending home sales are basically a leading indicator for the sector. Just like we looked on the front end of this when interest rates were really low and we weren't worried so much about inflation, we had, years worth of increasing prices and sales. We're now, fifth straight month of pending home sales falling. Although there is some good news potentially with interest rates decreasing. So for 30-year fixed rate mortgages, they decreased to about 6.5 last week, and that was down from 6.67. And then just one other interesting note on the housing side, the FHFA raised the threshold for mortgages eligible to be backstopped by Fannie and Freddie. This is the first time that the loan limit surpasses $1 million in what they consider high cost of living markets. So for conforming loans, the higher limit now is $1,089,300 next year, while the limit for non-high cost of living areas is going to be at $726,200, which is just really crazy. I remember brokering deals where the non-jumbo, conforming loan limit was in the 400,000 range. So it's almost doubled probably in the last 8 or so years. So just interesting tidbit there.
More McMansions on the way, right? That's the is that the takeaway, Lonnie?
I think that's it. It's really funny. I mean, what are we now? We're several months into this higher interest rate environment, and I think daily we still see publications coming out where people are showing the difference in mortgage payment between the 3% interest rate and a 6.5% interest rate. I don't think it's fully resonated with people what the difference looks like in terms of a monthly payment. But I think we're kind of getting to a point, man, is where we're going to start seeing an increase in transaction activity on the residential side now that people have come to terms a little bit with where rates have settled. It seems like they've been hovering in that 6 to 6.5%, marker for the last couple of months. So I think, prices will come down, but I think now that they've stabilized a little bit, people will maybe get back on the saddle and start, pursuing some transactions that maybe put off the last couple of months.
I mean, the move has been meaningful. The 10-year yield now is down, I believe, more than 75 basis points from its peak. And, that's going to lead to almost a 1% decline in interest rates from peak to where we are now. And that's, to your point, a reversal of the story we have been telling for several months, which is less affordability of housing, more of your paycheck going into paying for the same amount of home purchase as you would have 6 months ago or a year ago.
We had some interesting retail news come out considering Black Friday and Cyber Monday. So consumers spent about $35.5 billion online over the 5-day period post-Thanksgiving. That was according to Adobe Analytics. It looks like Cyber Monday was the biggest shopping day of the long weekend. Sales hit a record 11.3 billion, which was up 5.5% roughly over last year. Black Friday sales were up 2.3% to just over 9 billion. So it's interesting, while we're talking about increasing housing costs, the consumers are still spending significantly more money than they have the last couple of years, even though with inflation, they're probably getting less for their money on a relative basis.
And that's a great segue, Lonnie, to remind people that this time of year is a great gift to give the gift of the TreppWire podcast. Works at the beach, it works at the barbecue. You might even impress your mother-in-law if you walk around playing this in your home. And if you act now, you can get the bundle, maybe an 8x10 glossy of Lonnie, suitable for framing, or a figurine of Haley, X-Gal. Call her X-Gal here, the superhero who edits out all of our malaprops that come out every single week.
All the faux pas.
There we go.
So we thought maybe we would have a sneak peek of the delinquency report, but lo and behold, we actually may have the full data to share today.
Yes, I bypassed the first quarter of the Bills Patriots game to race this to the finish line tonight so we could get it out for Friday morning. It was a very unusual report. I wasn't expecting this, but maybe I should have, in that the rate overall would have been down, except for the fact that we saw a couple of big multifamily loans go delinquent this month that pushed up the rate of multifamily. So let me put this in perspective. The delinquency rate for about 2 years had been falling. Now, for 3 out of the last 4 months, the rate has increased. This month, the rate increased 3 basis points, but remains under 3%, barely. That being said, 4 of the 5 major property types saw improvements this month. Improvements from hotel, retail, office, and industrial. And in fact, hotel was quite meaningful. On the other end, a big uptick in multifamily delinquency, which erased the gains and then some for the other 4 property types. And that was driven by 2 loans of big size that went delinquent this month. One was a big 2019 portfolio loan that has been in and out of delinquency for the last year. The good news there is special servicer comments believe that a full payoff will take place at some point. The other one, which we wrote about in TreppWire, was a little bit more concerning. This involved a Queens apartment complex that went delinquent for the first time. That's a $220 million loan that went 30 days delinquent. So between these 2 loans, which total about $700 million between them, that was enough to push the multifamily delinquency rate up almost 100 basis points. And that in turn lifted the entire delinquency rate higher. So a very unusual report here. And it may not be the last type of story we see like this, because we talked about this last week and we put out a TreppWire story about this, that looming in the background is a big San Francisco multifamily loan that went to special servicing this month that could also find its way delinquent. So that's kind of the whole context of what we're going to put out tomorrow. For those of you that get our blog reports, you'll see this. The one caveat I would put into this is that it doesn't take much in the multifamily space to move that delinquency rate a lot. Most of the multifamily lending is done through the GSEs. We don't include those in our delinquency statistics. We only use private label CMBS multifamily for our numbers, largely because GSE debt is government insured. So the entire multifamily universe in the private label sector is only about 70 billion, give or take. So a few big loans can move that in a material way. And in this case, in this month, it did.
Yeah, I think just to give some context on the overall numbers, Manus, look at lodging 3 months ago was at 5.09%. This month it was at 4.54. So you saw, seeing a 50 basis point improvement for the last 3 months. And if you look at the retail sector, it was unchanged from last month, but it's been hovering around that 5.8% marker. September was 5.79, October at 5.85, and November coming in unchanged at 5.85. So agreed with you, you back out the multifamily and this would be a really, really good report on the whole. So it's good to see properties still performing across all asset classes, and hopefully the one multifamily deal that they think will have a positive outcome will revert back into a non-delinquent status heading into next month.
Yeah, I think the tone has been for several months that we're going to see an uptick in delinquencies. If you back out the multifamily, we would have seen a decline. And I think that we really would have defied people's expectations. People that are of the belief that higher rates, challenges, refinancing maturing loans, and a slowing U.S. economy are going to lead to higher delinquencies. In fact, Fitch this week came out with a report that said they expect delinquencies to double once we hit a recession, right? I think their terminal rate is between 4 and 6%. So that's the thesis. And I think there's a fair consensus around that, but it has yet to play out in any material way in the data we've seen.
It's interesting. I've been watching, because we track in our platform percentage of properties with debt service coverage less than 1. And if you look at a lot of the major metros, that number is pretty, alarmingly high across several asset classes, but it hasn't translated into delinquency. So like you're saying, people have still maintained the mortgage payment. I do think, though, it'll be interesting to see, like, as sentiment really shifts, if we do enter in a recession, or people believe that we're in a recessionary environment, which has been talked about for the last couple of months, but but the numbers haven't shown it. How many of those owners continue to put, their money in there to keep those payments current? So I think sentiment may shift if we start seeing a slowdown. And it'll be interesting to see, because if you look at the DSCR less than 1, there's a large number of properties that fall into that category that are still current on the mortgage, which just traditionally it wouldn't be the case.
Yeah, I don't think we've done any research on this yet, but it would be interesting. We should do this, which is an analysis of what percentage of those that are below 10x now were above 10x 6 months ago and are floating rate. That the only thing pushing these things below that 10x threshold is the higher rate. And maybe if we get time between now and the end of the year, we'll try to do some analysis on that, because that would really separate whether this is performance-based, revenue-based, or whether it's debt service-based.
And we also this week released our latest Life Comps returns report, which is returns for life insurance, commercial mortgage loans, and that didn't look so good.
Yeah, so the returns for the index has been negative for 3 quarters in a row, which is pointing towards, a steep negative annual outcome. The decreasing return is attributed to the rising rates. So not great news in the short term. There may be some tailwinds as interest rates stabilize. But for now, total returns on the Life Comps data does not look great. And if you are interested in that, we published a report this week, as Martha mentioned. We'd be happy to share that with you. If you have interest, please just email us at podcast@trepp.com and we'll send you a copy of that.
Yeah, this is of a piece that I think is, 7, 8, 9 months ago, one of our former hosts, Darren King, pointed this out, that so much of these negative returns are driven by the higher interest rate. So if you have, a long bond fund, a 10-year bond fund, 10-year duration bond fund, because the 10-year has gone up from 1.5% to 4%, you got killed on a value basis, right? You've seen, the value of your paper go down 25%. And I'm not an expert in the Life Comps data, but I have to think that has to be the driving force behind these negative returns. It's not asset selection. It's not credit events. It's got to be long duration impact of yield.
So I wanted to mention the Life Comps report was the byproduct of one of our newer associates, Ben Ching, that joined Trepp fairly recently, and he put together a really great report. He also runs our market source data products, which is a mixture of consortium data that we manage. So one is a bank balance sheet consortia where lenders contribute their CNI loans and their CRE loans, and we anonymize and aggregate that and then commercialize that in the marketplace to provide benchmarking and color. And he also runs the Life Comps Total Return Index, which we talked about, where he provides commentary and color around that as well. So, and if you like more information about either of those products or the data that comes from those products, the outputs, we'd be happy to put you in contact with Ben Ching so he could give you a little deeper color and analysis on those 2 assets.
Okay, let's dig into some of the property sectors. We've got some really long stories here. Many of these look rather complicated and involved. So let's start with office.
Yes, Martha, let's go through those. We're cutting this on West Coast time. This is like waiting for Nevada to play UCLA in basketball at 10 o'clock at night. We're doing like the West Coast delivery tonight. And like I said, we could end up being a little bit punchy. Here we go. So crabgrass, this is from Sarah Clearman of the San Francisco Business Times. Oracle is listing even more space for lease, in this case out in Pleasanton. They have already put out space or sold space in San Francisco and San Jose and Belmont. Now they're putting up 75% of the space in their Pleasanton office. That's at 5805 Owens Drive. More crabgrass. KKR was expected to take 300,000 square feet of space at a Tishman Spire project in Chelsea, which is kind of a little bit south and a little bit west of Madison Square Garden and Penn Station. That deal is now off. The story comes from BizNow. KKR is going to make do with their current space. Today, we saw an article that Meta was going to give back space, more space in New York, this time in Hudson Yards. We'll have a story about that next week in TreppWire. And then we do have some green shoots. So those were the negative stories. Let me run through a couple of green ones now. In Chicago, which has been really, really hard hit by delinquencies and tenant departures, we do have a positive story. Special servicer notes for the 100 and 150 South Wacker Drive property say that that loan will be defeased soon. The property is a 1.1 million square foot office in Chicago. It's downtown. It's one of the hardest hit areas of Chicago, that downtown market. Top tenants there include Schwab and Golub Capital. What we like about this is it backs about $120 million in CMBS debt, which should now be money good. Elsewhere in Cleveland, a big office portfolio there was modified in June. It's a $39.7 million portfolio that was slated to mature in July 2022. This may become the model for what we see with office loans over the next couple of years. The loan went to special servicing over the summer. There was a major tenant at the property, in this case, Park Place Technologies, that recently issued an RFP indicating that they would likely leave the collateral behind the loan. The top tenant is Progressive. They were also planning to vacate in early 2023. So this was a loan that, and a property that had a lot of issues. The borrower obviously wanted to keep this, otherwise they wouldn't have modified the note. The new term pushes the maturity date out to 2024, so a 2-year extension. The borrower also has 2 12-month extension options that could push the maturity out to 2026. So this is, it was a custody loan to begin with. In 2021, DSCR was 1.10x. Occupancy was 75%. Those numbers both fell in Q1 2022 and will fall once these other tenants leave. And yet here we have a borrower looking to step in and fight for this property. So a green shoot on the fact that the borrower is not throwing back the keys, and perhaps a model for how these things play out. Maybe CMBS investors look at this and say, you know, this is what we should expect for custody loans reaching their maturity where there's low DSCR and low occupancy.
Yeah, I think a takeaway on that one, Manis, was, you know, the sponsor had to make an equity contribution to facilitate the upcoming leasing needs. So we've talked a little bit about, you know, the potential for cash and refinance opportunities on some of these deals. This may be kind of a hybrid approach where they don't technically refinance, they just extend, but they require some sort of a capital contribution from the borrower, maybe a little bit less than they would if they were to do a full refi. But to your point, it extends the maturity date. The equity acts as, you know, additional collateral from the borrower to facilitate the extension. And then at the end of the deal, the property's, you know, back to lease stabilized occupancy, and maybe the market is a little more receptive to these office refinances at more favorable terms at that point.
You know, I was talking to a reporter from San Francisco yesterday, and she made a good point in our conversation, which I hadn't thought about before. But when we were going through the great financial crisis, it wasn't that unusual to see a form of relief for borrowers come in the form of a rate cut, right? That the loan might have carried a coupon of 6%, but the special servicer would say, we will let you pay 3% for the next 3 years and then step it up gradually so you can kind of build up reserves and so forth. What she pointed out, and it was a great observation, is by extending this loan, you're basically subsidizing them by not making them go out and get a new loan right now. I mean, this particular loan is not super low yield. It's a 5.20 coupon, this Cleveland East. But if they were to go to the capital markets today, if they could get a rate at all, it's probably 7.5, considering the DSCR and the occupancy, maybe even higher, or maybe there's no bid at all. So by allowing them to extend a 5.20 loan for 2 years, in a way, that's another form of relief.
All right. Before we move on to hotels, there was a story this week that Airbnb's launched a listing service for rental apartments with some of the more prominent owners and property managers in the country. Thought that was an interesting story.
Yeah, it is interesting. I mean, I think Airbnb is trying to grab as much market share as they can. They've been in the news a lot lately, and there's been a real big push from them in terms of technology upgrades, listing, offering upgrades, et cetera, et cetera. And now they're making a push into the multifamily rental space, which is an interesting concept. But it appears that there's some buy-in on the management ownership side of the apartment community. So there's about 175 buildings that have opted into this listing platform. Some of those are managed by Equity Residential, Greystar. There's 10 other companies that are part of this initial, pilot. And, those are some pretty big names in the operation management space. The site will, be a listing platform for rental apartments, as we mentioned, where basically the rental tenant, the resident, they're going to be permitted to list their units for sublease on this Airbnb platform. And it'll be specified in the lease term what the number of days is that they can actually sublease or, Airbnb these. Seems like 180 days is kind of the top end of that threshold. So it's something less than 180 days. So it'll be interesting to see how this rolls out in the marketplace. I'd definitely be interested to hear from our listeners their take on this, because I do think it's kind of a new concept relative to these large operators inviting Airbnb into their space. And we've seen what Airbnb's been able to do in terms of a market share play on the lodging sector. So maybe the apartments have decided it's better to create a frenemy type of relationship versus having them just organically come after them. So I think it's an interesting story. I don't really have a thought or position on this today. I think it's something worth watching, though. It'd be interesting to see if anyone that listens has a strong opinion one way or another on how this impacts the multifamily market at large.
So Martha, are you an Airbnb person or are you a hotel person? What is your go-to?
It depends. So for example, graduations, when you've got like a bunch of people, it's great to have a big place, lots of rooms, can spread out. When it's just, me and my husband, all you need is a hotel room. So it's really situational. And I think a lot of people use those spaces and their choices based on their circumstances.
Yes, I've yet to use an Airbnb. I still use DOS, so that's kind of goes to figure that between that and what did I used to have, a beeper, right? I've just
Pager.
got moved from pager from pager to BlackBerry. That I haven't even graduated to smartphone yet.
All right, let's move on to hotels.
Yeah, a couple of hotel stories that we will run through quickly. The first one, why did this one get my attention? It got my attention because of the complexity of the transaction, the challenges to people who trade CMBS bonds when looking at this thing, and also the fact that it's a green shoot. So the loan in question is a $770 million Starwood Lodging Hotel portfolio. The collateral is made up of 138 loans across the US. Obviously, 775 million is a big piece of paper. The portfolio has more than 10,000 rooms, and most of the hotels are limited service. So the note was supposed to mature last month, but Starwood and the special servicer have worked out an accommodation, which is a green shoot, right? That here you have another case where the borrower is not walking away. In this case, the maturity was extended to 2024, and the borrower has a 12-month extension option, which could push the maturity out another year. And by the way, a shout out to our own Ken Cheng in our bond finance team here, our modeling team, who did all the research and legwork on this particular story and updating our cash flow models. But the story here is that in addition to that particular part of the story, the extension, there is an agreement in place in which Starwood has an agreement that they will sell 49 properties for $250 million, if I'm not mistaken, which will reduce the balance of the loan sometime in the near future. And if there's not enough cash to provide a takeout price, which is high enough to meet the release price in the documents, Starwood will throw in extra cash to make those numbers work. So why did this, again, grab my attention? If you're a bond investor, you now have several variables that you have to consider. Variable number one is, okay, there's going to be a $250 million prepayment. When is that going to come in? Is it 3 months, 6 months? Is it a year? Sometimes these deals take a long time to play out. When you're done with that, what does DSCR look like? What is the likelihood that this thing gets refinanced in 2024 and not 2025? So I bring all this up because for some of our listeners, you're in not the capital markets, you're in the bricks and mortar or the leasing space or the brokerage space. This is some of the calculation that a trader or a money manager has to make when they decide, is this bond worth par? Is it worth 99 cents, 95 cents, 90 cents on the dollar? And sometimes there's a lot of moving pieces behind these calculations.
Yeah, it looks like on the equity contribution side of that, Manus, if they don't hit the release price, they're going to potentially contribute up to about 15 million in new equity. You got to look at this one and wonder, I guess, with those 49 properties being sold off, if maybe those are the properties that are underperforming, this may right size this portfolio and make it, profitable into the future. So this is a good deal all the way around. Hopefully the buyers of those 49 properties are going to be in a position to reset the basis on those and make them, actionable and profitable in the market. And for Starwood, maybe gets their portfolio in a little better shape on the go forward as well. So all in all, great story on this one.
So let's move on to retail. We have a couple of stories in retail.
Yes, one is kind of just raw commentary. We noted this in first-time servicer watch list notes for the $300 million Shops at Mission Viejo loan. The collateral there is a 1.1 million square foot super regional mall in Mission Viejo, California. Anchors include Macy's and Nordstrom's. The loan matures in February 2023. DSCR real strong, 2.25x in 2021, 2.13x in H1 2022. Both are down somewhat over the last couple of years, but still quite strong at over 2.0x. LTV at securitization only 54, so not terribly highly levered. No looming lease expirations among the top 5 tenants. So this is something you would think would be suitable for refinancing. The watch list notes, and I'll paraphrase here, serious headwinds in the market to refinance this asset. Market is as tough as you can imagine. So if you're a CMBS investor, probably time to say this might be a candidate for an extension. But it also makes you say, if a loan like this can't get refinanced, anything with a lower DSCR, with shorter lease expiration duration, and with higher LTV, probably doesn't have a chance.
Yeah, it makes you wonder as well, man, is CMBS had kind of been a catch-all for a lot of these large retail loans in the mall space. And if, to your point, this property that seems to be performing above expectations can't find financing, I wonder where these property owners actually go to get financing. I mean, are these assets even, is there an option for them in the marketplace given the circumstance on the macro? Because this is one that, based on some of the mall numbers that we've talked about over the last 6 months, is on the top tier of that. So I think it's interesting to see what will happen from here. I think we may actually see some of those changes that we've talked about, adaptive reuse or repositioning of some of these assets in the instance that there is no refinance market for them, given the appetite or lack of appetite, I would say, in the marketplace.
Yeah, given the strong numbers of this particular mall and this particular loan, my hunch is that this is an extension waiting to happen, right? Cash flow positive, strong numbers. The borrower probably needs to wait for more favorable interest rates and more favorable lending conditions to get this refinanced. I think this is a refinanceable property in different times, right? The ones you're talking about, and correct me if you disagree, but those are the ones where you're at the 120, 110, 130x. Occupancy is 88% with, 3 or 4 top tenants expiring between now and 2025. Those are the ones I think that a reuse situation much more likely.
Yeah, agreed. I wonder on this though, there's not much upside here. I mean, like, this is kind of a perfect storm on the good side where they don't have lease expirations. The DSCR numbers are better than the market. The occupancy is really strong. So I agree with you in this one. In practice, it'll probably be an extension. But I would contend that the number of mall properties that are going to meet this criteria are probably really, really small. And if this one is having to go through the extension route, I think it just doesn't bode well for the industry at large. Obviously, if interest rates come back down, it makes these a little more appealing, but maybe only somewhat more appealing, just because of the nature of the disdain for large regional mall type of assets.
Yeah, we talked about this before. Oz in Massachusetts, he took some exception with this, but I'll go back to the metaphor anyway. There is no crying in commercial real estate. You're very detached from this, right? You may cry when you sell the home you grew up in, right? There may be this emotional attachment. I don't think that exists in commercial real estate, that emotional attachment. It's just X's and O's. And if the borrower feels like they're throwing good money after bad, or even they might get a positive return putting money into this, but there's a more positive return elsewhere for their $20 million, there's no emotion in that, right? Their money is going to go to the place where their returns are best. And that's, there's no crying in that regard in commercial real estate. But Oz, come right back at me. You're welcome to. We can we can go at it again.
And moving on to industrial, I don't think there was any crying in Florida with the acquisition that we have there.
Yeah, I mean, that market just doesn't slow down at all. Higher interest rates don't seem to be impacting appetite for it yet. At some point that day will come, but it doesn't seem to be facing us anytime soon. This story is from Jordana Rothberg. She's of Commercial Property Executive. Her story was that TA Realty, which I believe is a Boston company, has acquired the Medley Commerce Center. That's a 1 million square foot industrial park in Medley, Florida. The asset sold for $241 million. That equates to almost $230 a square foot, making it one of South Florida's largest warehouse transactions this year.
Something to maybe footnote the industrial sector. I feel like we haven't talked nearly as much about industrial in the sense that the number of transactions have definitely slowed. I know there was a period there where it was like every week there were 3 or 4 new industrial deals that were setting price records. And while this is still great news and bodes well for the sector, I definitely have sensed a slowdown in terms of just overall transaction volume across the U.S.
Yeah, I mean, the industrial market really, it's hard to imagine it going any further up than it has been, right? Tremendous tailwinds from COVID, more e-commerce than ever before, enormous demand. We've seen it in the delinquency rate. I think that for loans that were issued after 2013, I think the delinquency rate for industrial is about 0.25%, right? In many markets, we're seeing vacancy rates of 2 and 3% for this market. So, it's hard to imagine this not being the salad days of the industrial period. At some point, we will run aground, but I don't think that's imminent.
And a new category that we are calling the unicorn.
Yes, we had interns over the summer, and we did an educational segment for them. And we talked about how losses are allocated across bond transactions, how we noted that when a loan or an REO property is resolved, any recovery goes to the highest rated bond as a principal recovery. Any loss comes from the bottom up. It writes down the bond that is the first loss bond in a particular transaction. So the transaction kind of gets barbelled a little bit. And so how would we describe it? Extraordinarily talented and bright intern from Indiana, he came up with this question: is there ever excess proceeds available for a loan? Does it ever sell for more than the debt on a loan so that you could replenish losses that have taken place in the past? And I said, well, in theory, that could happen, Michael, but in reality, it doesn't happen very often. Well, it did happen this month. We saw a 2014 deal, part of CMBX 8, where there was so much principal recovered for a particular asset that not only were principal on the loan able to be repaid, along with whatever servicer advances and interest shortfalls that existed on the asset, but there was an extra 1.8 million that was left to repay prior losses on the first loss G class of WFRBS 2014 C21. So we call this a unicorn. The asset in question was the Bluffs. It's a 602 unit apartment complex in Junction City, Kansas. It's near the Fort Riley Army Base, if you know that area. In this particular case, the property had a fire. The owner walked away. The property turned into REO. Market conditions improved, and the property was sold for considerably more than what was expected. In fact, the loan balance or the asset balance was 24 million, and resolution proceeds total 38 million. So in episode 168, spanning 30 months, we have our first unicorn.
I think maybe, Manus, you need to take this story and put it in a frame with a nice little, unicorn banner on there, autograph it, and send it to that intern, Michael C., as a commemorative takeaway from Trepp.
Or we could add it to the holiday bundle along with the figurine and the 8x10 glossy.
And we have a couple of programming notes. We've got some webinars coming up. December 6th, we've got the risk management webinar. It's open to everyone. It's got a nice panel that's led by our own Matt Anderson. We've got Pacific Premier Bank, Burke and Herbert, and M&T that are going to be on that panel. So you should check that out. And if you have questions, we'll be happy to give you the details. We've had a lot of questions about interest rate caps. And as a result, we're going to be doing a client-specific webinar. But if you are not a client and have questions, please reach out to us. We've got some information that we can share with you, and we'd be happy to talk with you about that as well. So if you have any interest in learning more about that, don't hesitate to let us know. And then on December 14th, we've got the Market Pulse webinar. Our own Lonnie and Stephen Bushbaum are going to be diving in to what's going on in the macroeconomic landscape and how that's impacting the various sectors, specifically office. So tune into that. And if you have questions about that, give us a shout and we'll give you more information. Turning to shoutouts, Ed D is a regular listener and appreciates all the work that we do and was looking for some lodging information. Anna P, a big fan and a listener, and she found out about the podcast from her NYU class. So thank you to her professor for opening her eyes. She's actually on the list for a potential future leader award. So good luck to Anna. And our loyal listener, Dan M, gave us an incredible podcast last week. Shout out. So thank you, Dan. He is always good for sharing our pod with his ecosystem, and he's got quite a big one, actually. And Brian B sent us an article on electric companies running out of transformers. It was really interesting. The NAHB is continuing to press the Biden administration to take some action because apparently there's a shortage of transformers. So they build houses and you can't light them up because they don't have electricity. That could be a problem.
Well, I'll fold this into a story. We kicked off the podcast tonight with talking about how we were recording this during NFL football. And it just reminded me, this whole transformer thing. This is going to take us pretty far afield. So this may, Haley, the ex-gal, may end up Xing this out. We'll have to see. But, we were such nutty Giant fans when we were kids. And our parents were too. It was a sickness. The Giants would win 1 or 2 games a year when we were kids. And they were so bad that they wouldn't sell out. And as a result, the games were blacked out in our neighborhood because if you didn't sell out, you couldn't show the game on TV. So my dad made us go out and buy this transformer that would turn the antenna on our house from pointing to New York City, where we lived on Long Island, to pointing to Boston, so that we could get the Boston station that would show miserable Giant football on Sunday. And 11 of us would sit on this threadbare couch watching black and white football from Boston. So it just reminded me of those days, that transformer that we'd have to operate and move the antenna every Sunday for the torture that was the Giants in the 1970s.
And now it's the Jets.
And the Jets are okay. The Jets might make the playoffs this year. We have to see.
This year. This year.
Yes.
I've been suffering for a very long time, Manus.
the long-suffering Jet fan.
That's right. And a couple more shout outs. Ryan G and team asked to be added to our research distribution list, so we hooked them up. And I know we talked about this amongst ourselves. Our Spotify 2022 stats are in, and they look very impressive. Our pod was in the top 5% of most shared globally. Apparently, people in 48 countries listened to it. Our listeners were categorized as super fans by Spotify. I'm pretty humbled by the fact that we're thought so highly of by our fans.
Yeah, I'd love to see some of their fans' phones. You know, they have that thing on Spotify where they show you what you listen to most during the course of the year. Wouldn't it be cool if some of these guys, you know, there was the Rolling Stones and there was a TreppWire podcast and then there was the Who or something like that, and we're like right in there. If you have that on your phone and you could take a picture of it and send it to us, we'll add it to the bundle.
You know, one of the takeaway stats from that I thought was interesting, Martha and Manus, was that we had a large contingent of listeners that listen right after the release each week. So I think we're going to test them a little bit tonight and see if they're willing to go the extra mile and wait a few more hours before they get to listen.
Well, it's funny. Haley gives us the statistics every week about, you know, how many listeners we have. And she told us last week we've cracked 500,000. I think we're between 500,000 and 600,000 now since we started the podcast. And we're averaging close to 5,000 listens per week, which is just incredible. And we're so grateful for that. But the crazy thing is, she says that some days before she gets her first cup of coffee in her, there's already 1,000 listeners from the night before, which is just incredible to me. We're just so humbled by that following, and it just, you know, it's amazing.
And if you're listening at midnight tonight, you got to let us know, because I want to know who you are. With that, we'll close. Thank you to our producer, Haley Keene, who's going to be working late tonight. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send it to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.